Hello guys, welcome back. Today we are going to discuss long-term contract. This is me RABEEH OVUNGAL. Welcome back to EduCafia. Yes, in the last videos, in the previous videos, we have already discussed these two terms like point in time and overtime. On that video, we said these two terms we will explain in coming videos. So this is the video where we are going to discuss this point in time and overtime. We can recognize the revenue. We just before in the previous video we studied what is the revenue recognition, when to recognize the revenue. In that, the revenue can be recognized two ways. One is point in time. When we receive the material, when we receive the control over the product, at the same time we can recognize the all revenue. That is point in time. Second is over time. When a construction is going on, when a construction of our house is going on, at each stage there will be many performance obligations that we already made in the agreement. Separate performance obligation. So whenever the separate performance obligation is happening, that time we can recognize each and every revenues at each and every time. So this is called overtime. So some contracts contain performance obligation that take time to complete. An obligation is satisfied when a customer obtains control of the asset. So in some long-term contracts, control transfers at point in time. Whenever we purchase a material from the supermarket or we are purchasing a car, so we are getting the control on a time, on a single time, that is point in time. But we are getting the control over the time. Periodically we are getting the control over that, then it is overtime. When we can call a contract is a overtime. A company satisfies the performance obligation overtime if it meet one of these 3 points. 3 conditions are there. In these, any 3 condition, any of these 3 condition is there in the contract, then it is a overtime. You consider the contract is constructing a house. So you imagine this contract is constructing a house. Then first point, the customer simultaneously receives and consumes the benefit as the company performs. Where we are constructing the house? We are constructing the house at the owner's plot. There will be a plot in the name of owner. In that owner's plot, we are constructing the house or building. So whenever we are constructing the house, the same time he can use that house because we are constructing in his place only. But in the case of a car, where the car is producing? The car is producing at the car company's factory. So while the production of that car, we don't have any control on that. So, but while the production or while the construction of a building in the owner's place, owner having the control on that construction. Second one, the company's work creates or enhances an asset that the customer control as it is created. While construction is going on, customer having the control on that. Yes, customer having control on that. Third point, the company performance doesn't create an asset with an alternative use, or the company has an enforceable right to payment for work completed to date. That means the construction is completed. Who constructed? Me only constructed. Now customer is saying, I am not going to give the payment. What I will do? I can't do anything because I constructed on his plot. I can't do anything. So I have the right to get the payment from him. But in the case of car, how it will be? Customer and coming and saying, okay, I am not buying that car. I am not ready to pay for that car. I don't have any problem. I can sell this car to another person. I can sell this car to another customer. It's not a problem for me because that car is with me only. The control is with me only. So I hope you understood the differences between the 3 points. So when any 3 of these points, any of one in this there in the contract, then that is overtime, not point in time. Okay, so what is point in time recognitions? Point in time recognitions is that the contract is reported on the balance sheet as it progresses, but revenue, cost, gross profit are recognized at a point in time. We understood that, okay, point in time is nothing but we are getting the product at the final time. We are getting the control over the product at the end of the time. When we receive the key of the car, at that time only we are getting the control over that. But we have to pay, we have to give the cash. It is there in the theory only. We have to give the cash. In the beginning, we have to give some advance for this car. Why we are giving the advance? Because they have to start the production. For starting the production, they have to buy steel, they have to buy tires, they have to buy engines. For this, they need money. So that amount they will consider as liability. They will consider as liability, we will consider as asset. But whenever we receive the car key, that time they can consider that amount as a revenue. That time only. Okay, so that is point in time recognition. So how it will be the journal entry in point in time recognition? Now you just consider we given the order for a car. It's just a Toyota Fortuner or Land Cruiser, whatever. It's a Toyota Land Cruiser. For this Land Cruiser, they started the production. So first of all, they will buy what? They have to buy the steel for the construction of the Land Cruiser. So they have many costers from their side for production of that. So what they will do? They will note all the cost. They will note all the cost of the production of that car in a book. In a book means in an account. That account is called construction in process. You know, working in process? Like that. Like working in progress, you know, right? So like that, WIP. Here it is CIP. Construction in process. Whatever expenses that is incurred from our side to produce that car, that we will charge in construction in process. But usually WIP is at the end of the time will be converted to FG, finished good. But here the CIP is not converted to finished good. It is not converted to finished good. Okay, the CIP will be removed from the balance sheet as expense that we will study with an example. So whatever cash we are credited, that whatever cash we are expensing as accounts payable for purchasing this steel, we may purchase this steel from another party. So accounts payable will be there, accrued wages will be there, labor charge will be there. So everything we will debit it to construction in process CIP. So according to me, it's an asset account. It's an asset account. Why? For me, it's an asset. Right. So this construction is process is an asset account. So in between the construction, I will send invoices. I will send small bill invoices to the party for getting the payment. That invoice is called billing on construction in process. That is my liability account. Against this construction in process, it is in my asset account. In my liability side, there will be another account, billing on construction in process. In this liability account, I will send some bill to customer. That time, accounts receivable is created. Accounts receivable. This bill, against this bill, customer will pay. That doesn't mean that customer will, in the bill, 10 lakhs is there. Customer will not pay 10 lakhs. He may pay 10 lakhs, but customer is only paying 8 lakhs means. That's why against this billing, we are preparing a accounts receivables 10 lakhs. If he pay 8 lakhs, balance 2 lakhs will be there in the accounts receivable. If in between I found, okay, whatever we understood in the contract, 20 lakhs is there. In the contract, 20 lakhs. The value of that car, we are selling that car to the customer for 20 lakhs. What is my cost? I estimated my cost is 50 lakhs. So 5 lakhs is my profit, right? So in between I understood, okay, my estimation is wrong. It is not 50 lakhs. It is going to be 16 lakhs. So 1 lakh extra loss is right? 1 lakh loss is there. So I estimated that loss is there. Then that loss I have to recognize immediately. So in my construction in process, whatever I shown in construction in process, that I have to reduce with the loss on long-term contract, this 1 lakh. So I have to recognize this, whatever whatever I estimated that is extra is there, means I have to recognize that loss immediately. So for your better understanding, we will discuss an example. Okay, so now the time of giving this key to the customer. Now we have sent many bills to the customer, right? That bills we will debit it and we will convert it to revenue. Now we will consider that as revenue. And the CIP account, I said to you, the CIP account is not going to be FG. We are going to convert the CIP account as construction expense. Now we will consider the CIP account as construction expense. Now what is the CIP account? The CIP account in balance sheet. Now whatever is there in the balance sheet, we will send it to income statement, P&L, that as construction expense. You got it? Whatever is there in the liability side as billing on construction process, that we will send it to P&L as revenue. Okay, we will do an example. Our company got a $20 million contract. It is nothing but we are making the value of that Land Cruiser. We are selling to a customer for 20 million. Okay, it will take 3 years to complete. It will take 3 years to make this Land Cruiser. Estimated cost 15 million. Estimated cost is 15 million. So these are the entries will come. In 2017, we will start first year. This is second year, 2018, third year, 2019. What are the costs? CIP, construction in progress. Every year, one CIP account we will add, right? This much we add. So these are the CIP. And estimated cost. How much cost will be there? And BIP, some bill we will send, right? So these are the bill we are sending. And some, according to that bill, some cash we will collect, right? So these are the cash we are collecting. Now, listen carefully, okay? 20 million is the contract. And 15 million I estimated in the beginning, 15 million will be the cost. So on 2017, first year, what is the cost incurred for me? That is 3 million. What is estimated? 15 million. Okay. In that 3 million cost incurred in 2017. In 2018, what is the total cost incurred? 8 million. That doesn't mean that 8 million incurred in 2018. No. That is 2017 plus 2018. So in that 8 million, 3 million is 2017. So only 5 million in 2018. You got it? In 2019, totally 16 million. 16 million. Estimated 15 million. Everything will not work as estimated. Estimated 15 million. But how much incurred? 16 million. Okay. So 16 million in 2019. So here 8 million in 2018. 8 million up to 2018. Then 2019, how much? 8 million incurred in 2019. In estimated cost in 2017, what is our estimation? What was our estimation? 15 million. Okay, as per the estimation. But in 2018, we understood it is not 15 million, it is 16 million. In 2019, as per the estimation, cost incurred. You got it? So we have to change the estimation cost that we studied, right? Then in 2017, we are sending what is our cost total incurred expense, how much? Really 3 million. But 2.5 million bill we are sending to the customer. And in that 2.5 million, customer gives 2 million. That much cash collected. In 2018, we are sending another bill 4 million. We got 3 million. In 2019, another bill we are sending 13.5 million. We got 15 million cash. Because here 0.5 million pending is there. Sorry, this is not 0.5 million is pending is there. Here 1 million pending is there. That 1.5 million plus this 13.5 million, total 15 million we got it. What is the total amount? 20 million. Correct? In 2019, how much we got? This 2 million plus 3 million plus 15 million is equal to 20 million. 20 million amount we received. How much bill it is sent? 2.5 million plus 4 million plus 13 million. So total 20 million bill also customer received. How much cost incurred? Total 16 million cost incurred. So we got the idea, right? So what will be the first journal entry? Whenever in 2017, 3 million cost incurred, that is payable, right? Maybe accounts payable against that material, maybe wages payable, whatever, total payable 3 million. That is we are debiting to CIP. That is 3 million. Crediting payable and CIP we are debiting. And 2018, we know that is 8 million. No. What is the increase in 2018? 5 million. How? 8 million minus 3 million. And in 2019, how much? 8 million. How? In 2018, up to 8 million. Here 16 million means 8 million increase here. So in 2018, 5 million payables that we are debiting to CIP account. That we are writing in the book. This much incurred. Then 2019, 8 million payables we are debiting to CIP account. Got it? Next, we are sending bill to the customer. That time, how much bill we are sending? 2017, 2.5 million. So 2.5 million bill we are sending to the customer. That creates an accounts receivable 2.5 million. In 2018, 4 million bill we are sending. So that 4 million bill send, that creates another 4 million accounts receivable. Then again 13.5 bill we are sending to the customer. In 13.5 bill sending to the customer, that creates debit 13.5 accounts receivables. This is debit and this is credit. You know, right? This is debit, this is credit. Then against this accounts receivables, 2017 this much accounts receivable is there. In that cash received 2 million. So I will credit accounts receivable 2 million. Next year I am received cash 3 million. So I am received cash 3 million. So I am crediting accounts receivables 3 million. Next year I am receiving 15 million cash. That I received cash 50 million debit. I am crediting accounts receivable 15 million. So these are the journal entries happening in this. Now you can see accounts receivable, this much accounts receivables was there. That was on debit, that's credited here, accounts receivables with the cash. So you can see this whatever payable account that is against with the supplier or wages. accounts receivables here closed. Is that cash received closed? No. Against what received? Not closed. This bill closed? No. This CIP account closed? No. This still open. So I told you that CIP account at the time of last point when we are giving the key of that car and we are giving the car also, at that time at 2019 we are how much bill total we given? 20 million. That we will debit and we will credit revenue 20 million. So against revenue we are debiting what? Bill. Then in CIP account 16 million is there as debit amount. This debit amount we will credit here 16 million as expense, as construction expense debited. So that's what I said. CIP is not becoming FG. CIP is directly converted to expense. Usually in WIP is converted to FG. But here CIP is not converted to FG. It is becoming expense. Here billings becoming revenue at when? 2019. Got it? So this is all about point in time. If it is overtime journal entry, if it is overtime, what will happen? Same as whenever the cash incurred for the construction of the building. Before it was the construction of a car. Here we are constructing a building. In the construction of the building, many expenses for us, right? So all the expenses we will write in CIP account. Not only the expenses, but also we will add the profit against the expense. Whenever we write the expenses, some profit is there, right? That profit also we will add to CIP account. That is the only difference here and there. There we are not adding the profit here. Here we will add a profit also. Whenever we will create a billing on construction, that time we will create an accounts receivables here. So now what is happening? Now whatever cash incurred, that we will add it to CIP account. Okay, whatever expense, then we are adding profit also. Then in between we will send a bill. Against that accounts receivables is created. Against that accounts receivable we will receive the cash. Then at the end of, we are giving the key of the house or the building to the house owner. That time the construction is processed. CIP account we are closing with the billing. There billing is closed with the revenue, CIP is closed with the expense. But here we are going to close CIP with the billing. How it is possible? In billing it will be 20 million. CIP will be 16 million. It is not possible, right? But here we already said, right? In CIP account we are going to add that 4 million profit also. Then this 4 plus 16 is equal to 20 million. Now it is okay, right? Billing and CIP will be equal. I know you are in confusion. I will show you an example. The same example, no changes in that. 20 million contract, 50 million estimated in the CIP account in the beginning 3 million, then 8 million, total 16 million. Okay, same. Estimated cost beginning it was 15, but later it was 16, and we are sending bill 2.5 million, 4 million, 13.5 million. Then cash collected 2 million, 3 million, 15 million. This much everything is same. Here we have to find out how much construction is covered or how much construction is completed. That we have to find it out. For finding that, there are many methods. Here we are taking coast to coast method. Coast to coast method we are choosing here. What is cost to cost method? In 2017, in CIP, we are estimated how much? 15 million. But really how much happened? 3 million. So how much? 3 million really happened, but estimated 15 million. So 20 percentage is completed, right? 3 by 15 is 20 percentage. So 20 percentage is completed in 2017. In 2018, how much happened? 8 million. No, 3 million is previous one. So in 2018, 5 million completed. What is my estimated cost? 16 million. So 5 million divided by 16 million is equal to 50 percentage. Sorry, that is equal to 30 percentage. So my 30 percentage work completed in 2018, but cumulative, here 20 percentage completed 2017, here also 30 percentage completed, so 50 percentage completed in 2018. Next year 2019, 16 million completed. That 2019, how much completed? I have added 8 million. What is my estimated cost? 16 million. So 8 million divided by 16 million, that is equal to 15 percentage. Another 15 percentage completed in 2019. So 100 percentage completed. This is how we are calculating the percentage of completion. Then same as like in the CAP and payable, 3 million CAP was there. How? Because of payable, 3 million payable was there in 2017, that we will add it to CAP account. In 2018, 5 million CAP added. So that payable 5 million we credited, that we will debit to CAP account 5 million. In 2019 also another 8 million, that 8 million payable was there, that we will be debited to 8 million to CAP account. Whenever now we are releasing bill, 2.5 million bill we are releasing. So 2.5 million bill we are releasing, that time an accounts receivable is created. Then 2018 also we are releasing 4 million. That time also accounts receivable is created. 2019, 13.5 bill is released. That time also accounts receivables is created. Then we are receiving cash against this bill, right? So whenever we receive cash, in 2017 we received cash 2 million. So we are crediting accounts receivable. Again 2018 we received cash 3 million. That time I am crediting accounts receivable. Then again 2019 I got 15 million cash, that I am crediting accounts receivable. So this much you understood, right? Now we said whenever we add to this to CAP account, we have to add what? We have to add profit also. How much profit? That how much percentage work completed, that much profit we have to add. So here, in 2017, 20 percentage work completed. In 2018, 30 percentage work completed. In 2019, 50 percentage work completed. So what is the total revenue? 20 million. Of this total revenue, 20 million, in the first year, 20 percentage work completed, that is 4 million. So my construction revenue in 2017, it is 4 million. But against that, my construction expense, how much? Only 3 million. So I need 1 more million, that. So that 1 more million is my profit that I will add to CAP account. So not only this 3 million is adding to CAP account, this 1 million also I am adding to CAP account. Then next 2018. 2018, I completed 30%. So 30% of 20 million is equal to 6 million. 30% of 20 million is equal to 6 million. That 6 million construction revenue I can recognize in 2018. In that, how much CIP I have recognized here? 5 million, right? So 5 million only is there in the construction expense. So when 6 million revenue is there, so extra 1 million I have to add it to CIP account. So not only this 5 million I am adding here, this 1 million also extra I am adding to CIP account. In next year, 2019, another 50% work completed in 2019. So 50% of 20 million is 10 million. In this 10 million, here 8 million CIP I added here, right? That 8 million is my construction expense. So balance 2 million is my profit. I am adding to CIP account. Now, I have sent this billings to the customer. That is totally equal to 20 million. There is no doubt. That is 20 million. And what is there in my CIP account? 60 million. There is also no doubt. Plus this extra I added in 2017. 17 million. Now it is 17 million. 16 plus 1, 17. In 2018, an extra 1 million also adding. So now it is 18 million. In 2019, I am adding another 2 million. Now it is 20 million in CIP account. So this is how the CIP account is closed with the billing, because revenue we are recognizing every year. Revenue we are recognizing every year. So the final CIP account we will close with the billings on 2019. You got it? So this is the differences between overtime and point in time. You got it? I hope you understood what is the theory of point in time and what is the theory of overtime and what is the differences between the point in time and overtime. You got it? So this is all about. I will pin this note in the description box. You can get it from there. See you on the next video. Bye bye.